Today's cardinal lesson is about long-term care, home health care, what is called custodial care, and really about your choices when you get older in whether you're going to stay at home or whether you have to go to a facility, to an assisted living facility. And it really, what we're talking about is this is a real possibility for many of us. And we're talking about preparing for it and essentially using our resources, our money, to buy choices and how all that plays out. So I want to talk about that a little bit before I talk about the solutions to the problem, which is insurance. So let's get clear on what we're talking about here. Is we're talking about paid assistance with activities like bathing, dressing, meals, housekeeping, errands, just generally getting about your day, the things that you take for granted now that you well could need some help with when you get older and you get more, you're sick, you develop some illnesses, and just getting about your day, things that you take for granted are difficult now, and you need help with them. And so that's really what custodial care is. Now, skilled care is a nurse, okay? And that could be factored into this whole situation here, but that's not what I'm talking about today. And that generally, if you need skilled care and you need a nurse taking care of you, and you need doctors taking care of you, and physical therapists, and that's all under the area of skilled care. And you may also need custodial care at the same time. That kind of all gets mixed together and possibly covered by Medicare. But I'm not talking about that. And most of this, at least in my plan for long-term care, I'm planning, and I certainly hope it works out that way when I start collecting on my policy, that it's going to be at home and it's going to be to my liking. And I'm going to have a say-so on how I set it up. And I'm going to be using the insurance company's money. You could say that's my own because I've paid dearly into this thing for quite a while. But nonetheless, I'm going to be getting back from the insurance company the reimbursements for this. So, when you just think about this, is you think about really your own parents. If you're in your 50s, 60s, 70s, and I often ask couples that I'm doing financial planning, retirement planning for, looking over their whole finances, I ask them about have they had an experience with long-term care and with custodial care? And when we generally go through the four parents, we're going to find at least one of them, they've been through this experience. And for those people, if you're one of those people, you don't need me to explain this to you. This is a real burden, especially on a married couple, because when you have two people, many times in their 80s, one of them begins to decline and they need help with these things. Who does the help? It's the other 80-year-old plus spouse. And you go on after a while, you got two sick people because this person can't even take a nap without being aware they can't sleep at night because the other person can't sleep at night. So long-term care insurance doesn't absolve that healthy spouse from all their duties. It gives them a break, or it lets somebody professional come in and do the heavy lifting. It also allows people to stay right in their own home, which as I survey people and I ask them those questions, generally that's the desire for most people. It's like mine, is to stay right in place with their own home. And there are home health care agencies that come out and they have professionals, they know how to do this, and they make it possible for one to go on continuing living their life. Now, proper insurance is going to let you stay in your own home. And I'm just telling you, it's much easier to spend the insurance company's money when you're 80s than start coming off of money that's in your savings account. I do a lot of consulting work for people in their 80s and 90s, where it's their younger children that are hiring me as a financial planner. Their parents are still alive and in this situation, and they haven't done any planning. And I come in the middle of the mess and try to make things better for the parent. We bring in some other consultants. And then what it really boils down to is grandma coming out of her bank account for $25 an hour for home health care for several hours a day. And that's not real pretty as talk. Even if Granny's a millionaire, multimillionaire, it's much easier when somebody's got some of this insurance in force to talk grandma into filing a claim on that policy she's been paying for years. So anyhow, enough about the need for it. Now we're going to get into the solution. And what comes to mind for most folks as soon as we talk about this is, what we now call traditional long-term care insurance. It's been around since the 70s and the 80s, about as long as I've been selling insurance. And I sold some of those early policies. Some of them are still in force, where people bought them very young and now they're very old. But traditional long-term care insurance had some problems with it. One is that the insurance companies in the beginning were just not charging enough. You say, well, how can that be? Why weren't they charging enough? Well, they guessed wrong, is they didn't guess for this low interest rate environment that we're in right now. They just assumed on the reserves that they set aside that they'd be earning a much greater amount. They also didn't plan for that nobody lapses these policies. So when you buy an insurance, pay for it for like 5 years and then drop it, the insurance company gets to keep all the money they had in reserves. They actually make money off of you. And then they plan that into their premiums, so they spread the benefit of that amongst the other people that kept the insurance. Well, when they have a planned lapse rate, what happened was, once people would buy these long-term care insurance policies, they don't let them go. I mean, it's amazing. And I've watched that. So with that all being said, these older policies, and I'm talking about the stuff that was sold in the 80s, the 90s, and then some in the first decade of the 2000s, they weren't charging enough. And then they had to have big rate increases. So that doesn't bear well for insurance companies and really for a whole industry, and people start blasting it, maybe rightly so, but nonetheless, it sheds poor light on this. And, which is sad, because it's going to turn, some people are just looking for an excuse not to buy this stuff or a reason. I just know from experience, because they just, man, I don't want to talk about that. And that just gives them one more reason. What I am going to tell you is this insurance is still around. It's more expensive now, so that you need to take a look at that. But it is still the least expensive way to get comprehensive protection of $300,000, $400,000, $500,000, $600,000 pool of money, which is kind of what you need to cover the whole risk over a number of years. It's the least expensive way to do that. Okay. Now, it's also somewhat difficult to qualify for. So if you have health conditions, serious health conditions, chronic conditions, and they're, have flared up in the last few years, you may not even be eligible for a traditional long-term care. So then again, some people say, well, I didn't want it anyhow, So on they go. Now, let's talk about the next number 2 here, recovery care or short-term care. People say, well, what's that? Well, it's 360 days or less. So it's anything under a year. Let's just call it a year. It's 1 year of coverage. So if you buy $5,000 a month in an assisted living, that's $60,000 of coverage, or 12 months, 360 days of coverage. So, and then you're out of coverage. So is this better than this? With this, you can cover 3, 4, 5 years. We even have some companies that offer unlimited coverage. So it'd pay for like 10, 12, 15 years. So you could look, on the one hand, you could say, well, this isn't very good. It just cuts me off after a year. Well, I can flip that and say, you got a year's worth of coverage, and this type of insurance also lets you use home health care. In fact, we have one policy called recovery care that actually has a separate benefit. It has 1 year of nursing home or assisted living coverage, and then it has a whole nother year of home health care coverage, and they're separate benefits. So you could spend a year at home collecting, then go to the assisted living. It'd really be 2 years. I don't want to get that technical about it, but where this really comes into play, even for very well-to-do people, we have many people, you can buy this policy on up through age 89 in most states. It is really good for that person who won't come off their own money, even though they have a lot of money. And a lot of people up in their 80s, they're just saving their money for their kids. They don't even really know what they're saving it for, but they're just not letting any of it go. And their kids are the ones that set up the home health care. And I've got situations where the lady fires them, or the old man just fires them. I don't want those people in my house. And, I looked at the money this is costing. We're not doing it. And the thing is if he doesn't have them in there, he's going to end up in a rest home or in an assisted living. So they're really facilitating. If he's got the money, she's got the money, it's still hard to get older folks to do that. You can have wealthy older folks, and if they've got some small insurance put in place, they're real fast. Oh yeah, the insurance company's paying for that. Yeah, just go ahead. You have those people come on. And even though it's their own money, but that serves a place there. Let's go to somebody of more moderate means. And there's a lot of people that just kick this can down the road. They've never bought the insurance. All of a sudden, dad has a stroke. The kids live out of town. Everybody's converging on the place. And when there's no insurance involved, we got to figure out what we're doing right now, because he's got to go to the facility. We got to get the home health care agency in. Maybe he can stay at home. But there's a need for this $5, $6, $7, $8 a month now. And so it's kind of sad, but that's the first thing that I help people with is what account are we going to pull this from? What are we going to liquidate? If you've got this short-term care insurance in place, and you got to buy this before you get sick, but if you have this in place, then that buys us a year to figure out how we're going to pay for it at the end of the year. So it puts you in a position at the 13th month where you're starting at the first month. So this is also much easier to qualify for. You can have some chronic conditions, and as long as they haven't flared up recently, we have some of these policies, we have them back in 2-3 days. So now the short-term care insurance is only in 39 states. So there's like 11 or 12 states that will not approve any short-term care. They just, it's like New York, Florida, California, Minnesota, Massachusetts, and then some other small ones. So if you live in one of those states, but you're also interested in a limited solution, we have a way to turn this to make it look affordable like this, or even to mess around with this. And so we've got some solutions for you. Give us a call, but in its pure form, this is only available in 39 states. And now we're going to move on to hybrid long-term care. So what's a hybrid? Well, a hybrid is the putting together of two things to make a new thing, okay? And in this case, it's life insurance or an annuity on this side, and it's long-term care insurance on this side, just like a stalk of corn or hybrid corn. It's going to birth a policy that's life insurance and long-term care. You say, well, how does that work? It was created, really, it's all about income taxes and tax deferral and tax-free payment of benefits. It was created by the Pension Protection Act of 2007. So what the Pension Protection Act did is it made it legal for interest rate growth and for money to come out of the death benefit of a life insurance to pay for long-term care. That's a bunch of mumbo jumbo, but what it means to you, the consumer, is if you buy hybrid long-term care, is somebody's going to get your money back, either your estate and your heirs or your children or your spouse. That would be if you pass away and you don't use it for long-term care, you just use it a little bit for long-term care. There's going to be a big payment. Or it's going to be you, if you use it for long-term care, it's going to pay out benefits just like this thing does. And some of these are going to pay out more benefits than the life insurance because they have extension riders on them. We even have one with a lifetime extension rider, so that if you really use it on the long-term care side, you could use it as long as you're alive for that. Now, if the third person that could get paid by it, again, is you, because if you transfer a lump sum into these policies, it's not like you've paid this money out to the insurance company and you're never going to get it, like it is with premiums with traditional long-term care. If you buy a hybrid life long-term care annuity, I mean, however we work, there's a cash value in there. Like my own personal policy has a cash value of about $130,000. And it just is, which is about what I've put into it over the last 10 years. And if I wanted to go get that money tomorrow, I could. Now, the downside of that, I'd be canceling my long-term care insurance. Now, it provides for long-term care between my wife and I, like $800,000, $900,000 of coverage for both of us. And then if we don't use it for long-term care, when the second one of us dies, there's going to be $300,000 that'll go to our kids, all that for an investment in our 50s and early 60s of $130,000. So hybrid long-term care makes a lot of sense for people that have the resources, and specifically for people that said, well, we'll just pay for that ourselves if that happens to us. And, this is a way that you can essentially put aside that money, still own the money, and then it have enhanced long-term care benefits. Then if you need it for long-term care, it's there. If you don't, then it's going to go to your state. So you really haven't parted with all the money. And it does cost more over time to carry this than this, because this has no estate value and no cash value for you to go get if you had an emergency. So I'm Hans Scheil, and I thank you for listening.